Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day, how you going? Phil Tarrant, co-host of Property Investing Insights with the crew over at Right Property Group, back in the studio recording for the first time as we enter an upwards interest rate cycle. Joining the studio, Reshmi and Victor Kumar, directors and founders over at Right Property Group. Gang, how you going, Reshmi? Good?
Good.
Yes.
Still exhausted?
Still exhausted, or from your holiday?
From the holidays. And the
She's demanding another holiday.
I actually really need one.
How often do you guys have the holiday? Do you sort of lock away time? Or?
Look, it depends. So length of time, obviously. So the longer holidays are during Christmas period. Yes, when kids are off school and whatnot. We try and lock in something in July as well. And
overseas or local? Or?
Depends.
Yeah.
Usually overseas, but it could be local as well. But every
few months we
every
try.
few months we go and recharge somewhere.
Yeah.
Did you make the great decision to buy a quasi holiday house at some point in time?
Yes, and we haven't been there for a while.
Was it Nelson Bay?
Yeah, Salamander Bay.
Salamander Bay. That's
So,
right.
so for
a very long time we didn't use it. It was just the dream
yeah,
of using it
well,
one day.
we don't do things by half. So we've got 2 units in that complex.
Oh, so you didn't just buy one, you bought two, just in case you needed to.
Yeah, just in case, Reshmi and I had Tiff and we've been a unit each.
Are they next to each other? Or are they
No, opposite
across.
each other, so
Opposite
across
each
the pool.
Yeah.
Oh, what was the logic of that? Thinking, oh, that's been nice. And then we can go up there and we can take some friends with us. They can stay in the other place and
Yes.
family, all that sort of stuff.
Yes. Plus,
Yeah.
it was still, it was a bargain at that time. Yeah.
Which is
yeah.
what we're going to talk about,
Yes.
right?
It's a bargain at the time. It's probably still a bargain, is it?
It would be a bargain for someone else, yes.
What'd you pay for them? Yeah.
We paid, it was bank valuation on that was $750 and we paid $350 for it back then because the developer was going broke. Yeah? Hence the bargain.
Oh, God. So you bought it when it was
During the GFC.
off the plan type?
No. Already built.
Okay.
And of course, during the GFC, a lot of sales fall through and all that. And the developer had to sell this to keep his home.
At half the price?
Half the price. Right? So
You bought two
two
of
at
them.
half the price. So, 2 for the price of 1.
2 for the price of
Yeah.
1. Are they nice?
They're very nice.
They're nice.
Yeah,
Yeah.
very nice. We've been there. We've taken friends now. We've done all that. But right in the beginning when we bought it, that was the thing that we were going to do that and we just
Go
didn't.
every other weekend.
Yeah.
Plus also, we said, okay, you know what? We're buying it half the price. We'll get it revalued from the bank and, pull the money back
It's
straight
always,
out.
so you're just making some money, are you?
Yeah, absolutely.
Yeah. Okay, still got it. That's cool.
Yeah, small thing called holding costs. Sorry.
Holding
Yeah,
costs.
just Sort of,
What do you do with them when you're not, like, are they full-time rental? Or are they,
No, they're full-time rental.
Yeah, okay.
So
Oh, there you go.
They bring in good rent.
Yeah.
So that's good.
Anyway, there you go. You can go up there for your holidays rather than
no,
overseas somewhere.
then you're going to the same spot every single time, right? And this is something when people are buying a holiday home and all that. While the kids are little, I suppose it works. But as they grow, they prefer not to go to the same spot
place.
every single time.
Yeah. Unless it's not really cool,
Yeah.
But, that's right. When last time you're back in Fiji, the home country?
Oh gosh.
while.
7
5
years.
years,
7 years
That
maybe.
long?
Yeah.
Yeah.
I thought
Or
you would have
more.
bought a resort out there by now.
No,
You said I know people have done it in the past and little,
Yeah.
No, not for you.
Not for me. Not for me. Yeah.
Well, it might be a bit harder now because interest rates have gone up.
It has gone up.
They did, earlier this month. How do you feel about that?
Opportunity.
Well, of course,
But
it's going to say opportunity.
proceed with caution is the mantra.
Okay, so does it matter that much that they've gone up?
If you haven't planned for it, absolutely does matter, right? If you haven't planned for unexpected expenses. But this is an expected expense, right? We know that interest rates lie around the 6% mark from a retail point of view. And we were on a trajectory upwards. So we had, I think, from memory, 11 rate rises
Yeah, it's about
consecutive.
right. From 0.1%.
Yeah. And then we had a little bit of a reprieve. Then we actually had one cut.
Yeah.
And then we had, a rate rise.
Did we have 2 cuts? 1 cut?
Two
3 cuts?
2 or 3 cuts, yeah.
3
I think
cuts.
2.
Yeah.
No.
2 cuts, 3 cuts.
2 cuts.
It's up of my pay grade, man.
Yeah, no.
I'll leave it to.
But let's go to the point, to
analysts,
go
yeah.
show how important it is. It's
Yeah.
like, oh, I think it's like, okay.
Yeah.
And,
But let's put things in perspective, right? So we've got a 0.25% increase in February, and we're recording this in the tail end of Feb.
Yeah.
And so if you've got $1 million mortgage, your repayments have gone up by $2,500 a year.
Yeah.
But let's put it in real perspective. It's $48.07 a week. Yeah. I bought, and you've bought me coffee today. And in the morning, I buy my coffee at the server near my home.
Of course, you buy it at the server. You probably pay $2.
No, this is expensive.
Okay.
That's where I'm going. So I buy almond milk, right? So of course that's another 80 cents on top. So my coffee costs me $6.10 a day. Yeah.
Is that like on a wild bean cafe?
Yes.
Okay. So it's not like the servo coffee.
No.
Yeah,
It's real
I was
coffee.
Going to say
Barista coffee.
He doesn't look like the sort of bloke that servo coffee.
Yeah. So let's say that, argument's sake, that the interest rates increase is $50 a week, right? So if I'm buying coffee every single day, pretty much I need to cut back on the coffee.
One coffee a day.
Yeah, one coffee a day.
Yeah.
To get that. But if I'm at that stage in holding a portfolio, man, have I got the wrong portfolio.
That's the point.
Mm-hmm.
Yeah.
If it really matters that much,
Yep.
you've probably got some bigger problems.
Yes.
I would say, because a lot of times, most investors, ourselves included, you just go, okay, it doesn't really change things.
No.
Doesn't really. You sort of buttress it, you weather it. It's all okay.
It's just a shot across the bows. Yeah, to say, hey, proceed with caution,
Yeah.
slow down. There is more coming your way if you continue down this path. And I'm talking about inflation. I'm talking about the over exuberance of property in today's market.
Yeah. Well, already, I think one of the banks came out yesterday, the day before, maybe it was CBA, saying expect more. I've been saying from when this rise come through, personally factoring at least 2 more
Yes.
this year. That's what I'd be doing if you were sort of sensible and prudent around it, which isn't going to change anything.
No.
Like
So
really,
if you're building a portfolio, you've got to be building that into knowing that there will be rate rises. That's part of the process, and just plan for it. And people relate the rise to the larger mortgage amount rather than looking, as you said,
Granular,
down to that level, and then see if you can hold on to your portfolio, or just don't do the panic selling or rush out and buy more because you're going to miss out or something like that. So
Yeah. Well, I think this is the sort of the core point around this. Around 2026 isn't around buying property; it's about building a portfolio, a resilient portfolio. And we sort of spoke on this previously, and it's really inherent to this whole design your decade type of thing. So you can have a good plan. Last time we got together, we spoke about pigeon pairing and bundling properties, and in different pods and pools for different purposes, which is sort of more at the strategic end of things, sophisticated end of things. But it starts somewhere with buying your buying your first properties. You need to be doing it in the sense of building out a portfolio. But now more than ever before, you need a portfolio creation strategy rather than just individual property, because when things like this happen, you're largely isolated to combat some of the shocks that may come around it, because you actually have a strategic view of it.
Yeah. And so one of the questions people ask themselves at this time is, is this the right time to buy? Should I stop buying? And Reshmi and I were discussing this in the car coming here, and as you know, we hashed the topic as we start driving.
I'm sure you did.
Yeah, it's very thought out.
Yeah.
Because we want to make it as relatable as possible in terms of what's really happening in life, rather than taking a really marketing approach to say, oh no, we're going to talk about this. Yes, it's taking down people down a journey, right? So when we're talking about whether we buy or not buy, there are a few things that people need to look at, right? Such as holding costs. And
the
so forth.
the holding cost is one thing. Yes, the borrowing capacity. People look at whether that's the really important thing, but your holding cost is more important. So if you're able to hold on to the property, you don't necessarily have to worry about your borrowing capacity, because you may not need to buy in that year. So if you've got a thought out process, a plan that this is what I'm doing, this is my portfolio, whether you're able to borrow or not is not an issue. It is whether you're able to hold on to that portfolio. That is what matters. So that's why we say plan out the whole thing, and everybody's plan would be different because we all have got different things happening in our life. We all different ages, our incomes are different, the amount of money we have saved up is different, what's coming up in our life is different. So that's where this kind of planning is kind of meanders into what steps you're going to take in what types of properties you're going to buy and what the environment is like, and looking at the whole of this scenario and then weave that into your own portfolio, how you're going to create that portfolio, because at the end of the day you're trying to get a result out of that portfolio. And all of these things kind of you have to take into account what's happening out there, what's your scenario and all the rest of it. So people focus on borrowing capacity. That's not the only thing. There's so many other things that you need to look at.
Yeah.
So as a mindset application to this, so rates go up, everyone sort of starts getting in a flap and a panic. Will there be additional rate rises? You would assume that there may be one or two more. Even some of the data coming out now would indicate that and telegraph that. And I see all the banks are actually tinkering with fixed rates on the way up. So that's a real tell about what's going on. So, okay, that's fine. That's happening. There's nothing you can do about it. You can't stop it, but you can react to it. So when interest rates go up, I ask you if it's a good thing, you think it's an opportunity. That's certainly a mindset thing.
Yeah.
Which is counter-cyclical to how most people go, I'll better stop and see what happens. Let's wait. Later.
If you look at what's really happening in the market, right? So if you look back at 2020, 21, where retail interest rate was 2%, right? So you borrow $1 million back then. And if you had the foresight of, say, perhaps fixing the loan long enough, and it's not very.
Some people are still just coming off 5 year.
I know. I hate them.
2%, 5 year.
I know.
But they're coming out going like, at least we're beyond all this sort of
which is where I'm leading
stuff,
to, right? So if you look at that, so back then, $1 million property or $1 million loan, was costing you $20,000 if it's interest only, $20,000 a year to hold. Fast forward to 2026. Now our average rate is sitting at, say, 6%. Yeah. And so now the 20,000 exposure is 60,000 exposure. So 3 times. Yeah.
That's a lot.
That's a lot. So, and then when you look at the recent data that's been released, right? So Q4 of last year, which data has just been released last week, we had the high in the last 5 years, which is coming back to your comment about fixed to 5 years. In the last 5 years, the last quarter was the highest number of mortgage inquiries in Australia. Yeah. So, and the mortgage inquiries was not from first-time buyers. It wasn't from people that were perhaps investing. It was more your middle-aged, your Gen X that were. If I call Gen X middle age, I think I'll have to go and wash my mouth with soap and water.
Is Gen X middle age? Gen X middle age?
So 40s to 50s, leading into 50s. Yeah. So they are the larger cohort of inquiries, and if you put 2 and 2 together, so this is where you need to look at the backstory of what's actually happening in terms of data. Yeah. If you put 2 and 2 together, they were the ones that were primarily positioned to take advantage of the 2% interest rates, the home upgraders and so forth. And now they're coming off their 5-year fixed rates, or they're coming to a point where, yes, I could still manage it because I was variable, but now I'm coming to a choke point where I'm seeing more rate rises or talk of rate rises at that point in time in the last quarter. So I better jump in and start restructuring my loans.
Yeah. Yeah. And therein lies the opportunities. So if you take a positive approach to it, and let's just assume that you've done all the right things over the last 5 years and build out buffers and, controlled your debt levels and haven't overexposed, you can run counter-cyclical to the market, Reshmi, where a lot of people will be stopping and waiting because they're really nervous around what the future holds. So do you stop buying or do you actually start buying? Well, the market largely isn't going to change too much as a result of a 25 basis point increase, even a 50 basis point increase, if it gets us back to where we are or were, because there's a whole bunch of other things running in parallel with this. The sort of 5% deposit scheme for first-time buyers. Even today, I was sitting having a chat with my broker, and she's like, "Yeah, Westpac's coming out of the blocks now at 95%.
They are.
Lends at 6.4 4% or 4-5%. I can't remember exactly the number. But that's aggressive. You know, that's going to be fueling a lot of activity in the market. So this is the point around interest rate, around mortgage inquiries. It's on the rise because there's so many other things running in parallel with this.
Yeah,
I think people are getting used to seeing those rate rises and they've become comfortable knowing where they're heading in that sense. And so it is okay to take that step and reassess things. And let's face it, these days people are more aware of how things work and what is out there, and they've been through a lot over the years to know and understand. So now people are taking charge of their scenario in this sense. What you were mentioning, whether to buy or not to buy or wait, it will come back to each person's scenario again. And people there's a lot of emotion that goes in when there's stories like rate rise happens, and there's a lot of emotions take over rather than the logical thinking. So people have to really drill down and sit with their brokers and work out the figures and know exactly. And if you, as you said before, at that point where you have to cut down on your coffee to hold a portfolio, then yes, that's not the correct thing for you.
You're going to start drinking cow milk again instead of almond milk. So things that tighten the Kumar household.
I know, right?
Yeah.
I'd probably, cut this budget and increase the kava budget.
Oh, you
right?
reckon? Got to prioritise these things. But this is about prioritisation, right?
Mindset. Yeah, clear mindset with kava.
So whether someone buys or not buy, it will be really totally dependent on their scenario and what they've got to play with. It's regardless of what's going on out there in the market. And remember the book Supercharge Your Property Portfolio. Yeah. It's regardless of what the market is doing. That's strategies in there that we've talked about.
So one of the things that we are seeing a mistake and we are educating our clients, right, is that this year and from pretty much mid last year, it is a market of take it slower and be very, very strategic in what property you put into the portfolio, because now you need to focus on the portfolio and the ability to build a portfolio. If you went willy-nilly, just bought a property, yes, you'll get in the market, absolutely. But does that then take you away from being able to add to the portfolio further? And something as simple as, okay, if you have a budget of, say, 600K and you're adamant that you want to buy a house because that's what all the social media spruiking is at the moment, right? And there's some merit to that. But in your budget constraints, in terms of how much the holding cost has to be for that to be able to cater for lifestyle, be able to cater for life, the ups and downs of the finance requirements of life, and still have a portfolio developing, you need to adjust that expectation. So it could perhaps be better to buy a 450K townhouse or villa that is closer to the main drag, as opposed to buying a house that's way out where if the tide then turns, maybe it's not as liquid, or maybe the holding cost is still way too high, and it actually prevents you from then scaling your portfolio and buying the next one sooner. You'd rather be in the game than be sitting on the sidelines waiting for the perfect opportunity to come and the market keeps moving up. And then, of course, this is where you do take the time. So our lead times with our clients is 3 to 4 months to find a property, sometimes longer if it's more specific, if the holding cost is so exact. So that we can cater for, okay, next year we've got the private school fees coming in, or next year we've got pubs coming in, or we're changing employment, or it's coming to a point where I am starting to worry about my portfolio. So we need to hook in the right type of property into that, so that it then doesn't become something that stifles the portfolio, it stifles the investing. One property, you are probably you've dipped your toes in the market, right? 2 properties, you're doing okay. 3 plus, you're definitely building a portfolio then.
And this is the point around 2026 not being about buying a property, it's about building a portfolio, and that can be quite, a philosophical sort of view of it all. So I want to just drill down into that a little bit more, gang. And from the point of, well, that's nice to say if you actually going to build a portfolio.
Yep.
Most people don't build a portfolio. They buy a couple of properties and that's it. And that's what the stats tell you. So there's a difference between people who invest in a longer term wealth creation strategy using property and probably listening to a podcast or watching a podcast like this. So conceptually, pull apart, because in order to build a portfolio, you have to buy the property.
Yeah.
And the first
Absolutely.
properties matter, but they probably don't matter that much. Like you just need to make sure your first properties are growth assets, probably over yielding assets, and that's when you'll pivot your strategy around it. So, I don't want people to get too absorbed or obsessed with this and stifle decision making. Going, oh, that's not exactly right because to your point, what happens if we change our job next? But sometimes you just got to do it.
Yeah, you just got to do it. You've got to,
But you cannot lose focus
Yeah.
of the bigger picture.
Yeah.
This is what you're trying to achieve. So yes, there's a good property and you are buying 2 or 3 properties, let's say, for example, and there's a good property there that you think it's a good property and everyone thinks it's a good property, but it may not be the good property for you because of your circumstances, whereas it's an excellent opportunity for somebody else. And that property may have much higher holding cost, and whereas you limited with your funds, your goals are different, and you may not be able to then allow that property may not be able to then allow you to go and buy a further property so that you can get to your goal. It will be a hindrance, though it's a great property and it could be a good one for somebody else, but for your portfolio, because of your scenario, it's not fitting in.
So
And
how
that's
do
the
you know?
mistake.
How do you know though?
And
Like how,
you
how,
don't
how
till you've
good or
done
bad
it.
or indifferent a property is,
Yeah.
right? Like, and
Yeah.
most people do this themselves, right? They don't use the buyer's agent. So yes, there's a lot more information around. You can be a lot more informed, but there's so much info out there. You just stifle, right?
You
I
only
bought-
get to know this like so many years after.
Yeah.
You
Yeah,
know,
you only
when
know.
You just know it because you've done it and you made those mistakes. I mean, we did the same thing. We were picking properties like, oh, this is
We are
great property.
collectors, not investors.
Yeah.
Yeah.
And then it, you think, well, this is not really.
When did you stop becoming a collector and start becoming an investor? Like how far through?
I think year
And what was it
year
like?
2000.
Ten.
Year 2000, I think, yeah.
Who was it that went, oh, we've probably just been a bit haphazard with this and but you started, right? So
Yeah.
you're,
We
you're,
started.
you're able to actually pivot.
I think around 2.5 for me, really, when I was like, okay, because you were quite a lot more switched on, and I was like, okay, this
Sorry,
is...
that's on record now.
Yeah.
Was
Yeah,
Victor
no.
going, just put another property?
No, 2.5 is when she was supposed to... 2.3 maybe
Yeah.
for me. Yeah.
Yeah.
Yeah. This is... Yeah.
So it's so the idea when you building a portfolio is to be granular, not look at your headline debt. You're looking at your operating costs, right? So how much it's costing you to hold onto the portfolio without taking tax concessions into account. And we always do our calculations without tax coming into play, right? So once you've started looking at that, it then helps you decide whether an addition to the portfolio is feasible, whether it's just a first property, whether you need to get to your ceiling of debt or be safe and go slightly below, or in a situation where you've still got some breathing power when the market turns against you. Because at some point in time it will, right? It's life could throw something at you, the economy could go, the lending could change. So all of these movements you need to take into account and say, okay, what's my get out of jail in terms of restructuring the debt, to be able to get more money to hold on to the property, because the bad times, the longest it normally lasts is about 18 months.
Yeah.
Yeah. And then it turns. And those that have been able to hold for that 18 months are able to then really scale their portfolio, because then they get into massive equity or really good cash flow. So if we're talking one property as an example, we really need to be looking at it from a holding cost point of view. And then that then helps you determine where you're buying, because each state, each area has got different holding costs, right? So it could be that the same budget could take you into another area which is perhaps at a different phase of the cycle and has got a slower growth than the explosive growth another area is offering. But you can't guarantee growth, so you better focus on the holding cost. So if you're going to a slower moving market and it's now costing you half of what the explosive growth property is going to cost, it keeps your powder dry for other opportunities. It keeps that mantra of lifestyle and life in the forefront and investing in the background, so that it doesn't become all consuming. And then you have to then rationalize on whether you go to Wild Bean Cafe or not.
So, you think about within our investing journey, we've seen the GFC and then also COVID, right?
Yep.
So 15 years apart from each other. So you need to go back through history and you'll see other things like that, right? So you'd be safe to assume that there is something around the corner.
Very much
How
so.
far around the corner, who knows, right? So how do you balance then the needs of resilience and protecting for these black swan events versus being in a period of explosive growth or redlining it? Like, you're sort of rolling the dice a little bit on this, right?
Yeah, absolutely.
So how can you do both of those things simultaneously? I think you can do it. That's what we spoke about last week. So you can sort of, isolate certain parts of your portfolio and leave it, don't touch it, and you can have a bit of your portfolio which is your aggressive bit, right? That's my philosophy to it all. So you've always got a fallback position, but that's a privilege of owning a larger portfolio rather than a smaller portfolio. But people who are just starting out, you don't want to be caught redlining when the music stops, right?
True.
And it will at some point.
Yeah, absolutely. And sometimes if you're looking at it just purely from a growth, the growth does come with a holding cost, right? So you need to equate the two. So to say, okay, if it's costing me, say, $30,000 a year before tax to hold on to this property, and the growth is $60,000 a year. I'm just throwing numbers out there. Make it a little bit more sexy. $100,000 a year. Right?
That's the sort of return you'd expect. Right?
So your net gain is circa $70K. Yeah. What if we went somewhere else where the holding cost wasn't $30K?
Yeah.
And the holding cost was, say, $12K, $15K for that matter, right? Just halve it. Yeah. And now your net income, assuming the rents are relatively the same, the net income is coming in, which is $15K better. Your growth may be, say, 90K or 80K in that suburb, in that state. But it allows you to then leverage into the next ones. If your capacity is 30K of negative cash flow, now you can get into two performing assets. 2 of 70 is definitely better than 1 of 100.
And that's the leverage, right? And you need to be able to think and view it that way.
Yes.
Which can be hard if you don't have the experience.
Yep.
And you must all chat with a lot of clients, Reshmi, and you talk about what you think are very basic concepts, but sort of mind-blowing for a lot of people. And some people still, they understand this negative gearing thing. They go, whoa, I didn't really understand. Or why I can actually refinance a property and take money out and use that for a deposit, which everyone thinks is pretty normal. But for a lot of people, it's a new concept you got to learn once.
It is a new concept, but it's lesser and lesser. We still come across people who are getting to see the idea and like, oh wow, I didn't realize I could do this. Yeah. So yeah,
and it must be nice for people to stumble across these things. But
it's actually nice when we sit down and map out that this is the money you have, and these are the ways. If this is the type of goal you have. And we can make this happen. Firstly, people come without a goal in mind. They have got no idea. They just want to buy property.
Yeah.
And that's the sad part, because why do you want to buy the property? Just because everybody is buying. So when we drill it down and we work out, okay, well, you're buying property. It's a lot of money. It's a lot of time you're going to put into this. Like, it's part of your life now. The end result, what will it give you? It's not like just buying. I know so many people who've bought properties, but they're sitting there. If we, I don't know if I should say this, but if we help, we know of people, but they could have that portfolio work for them, but they have decent amount of properties. They could have that portfolio work for them, but they don't understand that, and they just know that they have these properties.
Yeah.
So the properties are there, but they don't know how to make it work for them and get them. They've had these properties for a very long time, and there's so much they could do, but because they're not a client of ours, or they're not necessarily going to listen to what we've got to say. So people have properties, but that's all that is. they have properties.
So this is one of the things I do for those that aren't across it is I do what's called a Wednesday wisdom. So this is a quick, short thought bubble every Wednesday morning as I'm driving to the office. I'm thinking about, okay, what's resonating with me this week? And then I just jump on, put the iPhone on my desk and yap away. And so if you go on our YouTube channel, you'll see that. And one of the things I talked about recently is is property your tool that you're using, or are you actually working for the property portfolio? So is the portfolio working for you, or are you working for the portfolio, right? Yeah. Now, obviously, in the beginning, you would work for the portfolio. In other words, equate that to the negative cash flow. But there needs to be a definitive journey mapped out to say, okay, this is where I want to head within the next 10 years, 15 years, 20 years, depending on your circumstances. And then you head towards it and you're plugging in then the right properties in terms of, okay, I bought the first one, maybe I shouldn't buy another for 18 months, forget what the headlines are. Maybe I shouldn't sell, forget what they're talking about capital gains tax, it's just a thought bubble at the moment, all those things. Right. So we're not reacting to the headlines, you are building your portfolio, then you're plugging in the next one, and perhaps then you're educating yourselves and you're empowering yourselves to get into a commercial property to neatly tie it together to make it positive cash flow, because ultimately at the end, it's the income that gives you the lifestyle, not the equity. You can't spend the equity, right? So if you start looking at it that way, then you bring it back to what's my progression. It actually slows you down in building the portfolio, but you're getting into a much sure-footed, predictable results that does not impact lifestyle in the beginning, but it has a huge impact on lifestyle to the positive in the tail end. And the tail end is determined by your time frame. Is it age 65? Is it age 50? Is it, I want to hand it down to the kids, which I would sort of question. You look after yourself first. But they are things that we need to look at. I listen to a lot of podcasts, and I read a lot of books. And I don't know where I've read this or heard this. They're talking about baking a cake. So you've got all the ingredients there. You can pull everything in, and we've got the oven at 180 degrees and pre-warmed, and everything's ready. But you haven't decided what type of cake you want to make. Is it a sponge cake? Is it a chocolate cake? Is it a multi-layered tiered cake? As you can see, I'm a cake expert.
Right.
Multi-layered just from the birthday.
And we had the 80th birthday for your mother. So
Can you bake a cake?
No, it was a multi-layered cake.
So you need to decide what cake you're baking to be able to get to that result, right? Otherwise, you're going to end up with hodgepodge. Yeah. So that's same with building a portfolio. Is you need to understand what you've got the ingredients. Right? You need to understand what you're going to do with the ingredients. What's the end result look like to be able to get there?
Yeah, it's not a bad analogy, because a lot of the ingredients for a cake is universal, with some little bits around the edges, which
the sprinkling,
which make a difference. Whether it's a sponge or whatever. I can bake a cake. I can bake a cake, by the way. But you can give the same ingredients to 10 different people, and you're going to get 10 different outcomes.
Absolutely.
And that's what property investment is. It's capital, it's debt, and it's decision making. That's all property investment.
And the recipe is the same with the cake, and it comes different for each person.
You buy it and it goes up, and then you realise that in some capacity, right? So it's not that hard, but it's pretty difficult.
It is.
It is very difficult.
It's very, very difficult. It's difficult to get right. But
how do you fold in the eggs in there? All the sort of stuff.
All that stuff.
Oh
How long?
Seems like
you fold it in. Do you use a blender? Do you use a mix master?
Or do you just use a simple fork, right? The old-fashioned way.
Yeah.
So all those things matter.
Oh gosh!
Baking cakes with Victor. It could be on your YouTube channel.
Yeah, that's right. Me with the apron, right?
So back to the point around interest rate rise, and let's throw into the mix.
I see what you've done there.
Changes to CGT, potential CGT changes. So whether or not this and the commentary has sort of softened a little bit over the last sort of week or so around this. You've got a new opposition leader, and they're sort of changing the script a little bit and turning it up. So it's taken a little bit of the heat off a lot of that discussion around it. But It's been bandied around that any changes to capital gains tax discounts will be sort of take place in the May budget, which means it'll probably come to fruition sort of next financial year. Is that really going to matter that much? Like, are people already getting jittery around this? And I've been pretty vocal in what I think it all means. I think it's a bit foolish to start messing with that. But what do you reckon, mate?
You could see I was just jumping at the bit, right?
Yeah.
Look, history is a great teacher.
Yeah.
And so we just need to look at our neighbours, New Zealand.
Yeah.
2021, they got rid of capital gains tax.
Yeah.
And they've just brought it back in.
Is it back in now?
It's back in now.
When did that happen?
Late last year.
Okay.
Someone can fact check that. But
I still thought you didn't pay capital gains.
No. It was tiered against a number of properties now, right?
Right.
So, and the resultant was that the rent skyrocketed.
Yeah.
Yeah, the rent skyrocketed. Obviously, there were other factors playing in as well, right?
So once they reintroduced it, rents went up.
When
No.
the rent stabilized,
Okay.
right? Because
So-
people are trying to get more cash flow to then offset what capital gains they will pay when they do sell, right? But what it does when we have this regime change in terms of tax and all that, it is a sovereign risk, right? You've got no control over it. You and me can't change that train wreck from happening.
Yeah. Well, we can vote,
Yeah.
but that's one vote, Yeah.
That's right. So the reality is that, yes, it will create an upheaval, 18 months thereabouts, right? And then the market will reset and that becomes the new norm. So don't let these headlines dictate your investing decisions. Stick to the fundamentals. Buy in prime owner-occupier areas. Your owner-occupier rate needs to be 60% plus. You need to look at the sellability of the property so that whether it's planned or unplanned, you're able to sell that in any market and walk away with your money. And make sure it doesn't bleed you dry from a cash flow point of view.
It's pretty simple. It is pretty simple. And should there be changes to capital gains tax, it would be a shock to the system, but it will normalise. But, this is when structure becomes really important. Really important.
So if we go back to the last podcast when Reshmi, you and I were talking about the pod system, right? So each property is supporting each other in a silo. If you had that, now obviously it takes time to build that, right? 3 to 5 years to get to that stage. But if you've got a property that's not actually draining your cash flow, you are immune to, or not immune, you are unconcerned about interest rate rises unless it jumps to 12%, then everyone's in trouble. You are
including the banks.
Yes. Yeah.
Including the government.
Yep. And so again, those things last months only. And then you are unconcerned about change in tax position. And what you are really concerned about is, okay, how can I build up another of this pod because this is life changing?
Yeah.
Just on that matter, I remember how we were talking about land tax.
Yes.
That was not so far back. So same sort of scenario.
Yeah, same scenario.
Yeah.
So,
you guys will be getting all your land tax bills at the moment. They're all coming
plenty of
through.
them.
Yeah. Did you payment plan it, or do you pay it out in total? Don't know.
The cheapest loan that you can get is a payment plan.
Yeah.
Yeah.
So you put payment plans on all your
Payment
land
plans,
tax.
absolutely. I mean, I want to keep my cash flow.
Yeah.
Yeah. And you can always renegotiate with them to say, hey, I'll pay this out early, reverse the interest. Yeah.
Yeah, and it's not a lot to be.
No, it's
fair.
not a lot.
Like
Not a
you know,
lot, yeah.
but, and if you do the math, you're probably better off having that money in an offset
Correct.
and paying the tax on it.
Yep.
And that would be a deduction anyway, right?
Land tax is a deduction
Is the
because it's a
interest on land
state-based
tax.
tax.
Is interest on land tax a deduction?
Yes.
Yeah.
Yeah.
There
Speak
go.
to your accountant.
Speak
But
to your accountant.
Good accountant will get you the
But
deduction.
this is the depth of
within the
detail you
legal
need to go
regs,
into
yeah.
it. So most investors I know who have large portfolios, they payment plan it.
Yeah.
And just
Yeah.
pay it off over with the cash flow.
Yeah.
Hold on to your money.
Hold on to your money. Yeah. So one of the things that if you take a takeaway from
Sorry,
today's-
how
Yep.
big would the land tax amount need to be per property for you to worry about doing a payment plan? If it's like $1,000 or $2,000,
$1,000 to the $2,000,
Yeah,
I'd
you'd
pay
pay
it.
it.
Yeah. But we're talking tens of thousands in our portfolio.
Yeah.
I would imagine. Yeah,
Yeah, it's one of my biggest costs.
yeah, it would be.
Yeah.
Next
Yeah.
to interest rates, that's one of my biggest costs.
Yeah, because of
Yeah,
structure,
and it
right?
crept up over the years. It's
Yeah.
like, oh my gosh.
Yeah, I'm getting on mine right now. I'm just going, oh god.
Yeah.
Even like going back to structure, if it's in a trust, family trust, obviously you get no threshold.
Depending on the state.
But depending on the state, say New South Wales, for example. But if it's in a company structure, you get the threshold, right?
$1,75,000. Yeah. So that's a really good thought process in terms of when you're buying property. Just don't buy without thinking it through. Depending on the state, you set up the right entity and buy accordingly, because you need to look at it from a long-term plan. Yeah. So that then you don't have to do this big asset realignment when you're coming into retirement.
And that's a hassle, right? So you do it a bit of pain at the front end. You've got to manage it. But, if you look at the consequences of a $2 million property in New South Wales sitting in a family trust that you pay 100% of the land tax on.
Correct.
Whereas if it was in a company, you get your $1,075,000 threshold, and then you pay the difference, right? Like you're saving the accounting fees pretty much already just by having that, so you're covering that cost. You're going to pay the same amount of money, but you're covering it. But you've got the long-term planning and tax consequences of having that inside of it. Because if you go back to changing capital gains tax stuff, like a lot of that will apply to people holding properties in individual names. But if it's sitting inside of a company structure,
capped, isn't it?
It's capped at company tax rates. And
you may not get the discount, but it's capped.
It's structurally capped. So it's now more than ever before. It's more about just not buying the property. It's about building a portfolio.
It is.
And building a portfolio is not only about the property that's in city. That's one small but important part. It's about all these other aspects of it, Reshmi.
The diversification of entities is what I was thinking about because we never know what they might decide to change or not change or whatever. So what I was thinking about is when you mentioned the pod system and you said pod, and I just thought people might think that a pod is all properties in one entity.
No.
I just wanted to clarify that a pod of, let's say, 5 properties in this one pod, they could all be, the ownership could be all different.
Different.
Look at it from a household point of view.
But they have a relationship with each other rather than structurally. Or they might all structurally sit in the same vehicle. They might not. But it's the relationship of them with each other. And
with each
maturity
other.
and life cycle.
They're not in the one state. They diversify different types of properties and all that sort of stuff. Yeah. So if you look at what 2026 should really look like, it is all about the architecture of buying property, not just buying the house, and also looking at it from a sequencing point of view, right? So what sequence do you buy the property? That's really important, especially in a rising market, interest rate wise, and how frenzied the market is in terms of acquisitions. Sequencing is really important. Don't get caught up in the headlines and say houses only. Could be villas and townhouses based on your circumstances. The holding cost may be cheaper. Yes, your growth will lag a bit, but at least you're in the market.
So how frenzied is the market right now? Right, you've been at this for a couple of decades. Is it in a frenzied environment right now?
It's the most frenzied I've ever seen in terms of where there is unconditional offers on properties that shouldn't have unconditional offers.
Why?
People are afraid of missing out.
FOMO.
Really? But it's not the market's not that. It's not like
it's not gangbusters.
It's not like coming out of the back of COVID when everything went nuts, right? Like it's a pretty normal market. So
it is a normal market, but it is not normalized because of the entrance of a lot of buyers agents, right? So you look at it from if a buyer's agent goes, so if a mum and dad investor goes into an area, that's one transaction they're doing. If a buyer's agent goes into an area, it could be potentially 10 transactions. And of course, that's going to heat up the market. Yeah. So that is a change that is happening. And we need to be take a very cautionary approach towards purchasing, because who are we competing against? Are we competing against the mum and dad investors, the home upgraders, the first home buyers? Or are we also competing against them, plus the myriad of buyers agents that are following data and only going into one area?
And this is the point, and I think it was the December numbers, and I'll probably get this wrong, but I'll get it close. In lending in New South Wales, like 47% were to investors, right? It's nearly half of the market investors. So I'd like to see what that is down in Melbourne, because Melbourne's pretty still. There's a lot of reasons why you shouldn't be investing in Melbourne or Victoria.
Yeah, and also a lot of reasons why you should.
And there's also a lot of reasons why you should.
And if we take history,
so despite all the issues why you shouldn't be investing in Victoria,
because that's a generic
still-
approach. And then again, it comes down to your portfolio, your scenario. That particular property may still be suitable for you. You know, so it's again,
and then you mentioning, the what is it, 40%, 60% of the loans in New South Wales was investors, right?
40%.
40%.
40%, yeah.
Okay, so the last time that happened was back in 2018.
Yeah, okay.
And guess what happened?
Yeah,
right?
friends at APRA.
Good old friends at
But they
APRA
try to
as
put the
well,
brakes
right?
on with this higher DCI
Yes.
stuff anyway, right? And that might, but still, there's still a lot of capacity in banks' loan books.
Yes.
Like this is why Westpac
Yeah.
going at 95%. Well, they've obviously got fat in their loan book to be able to lend up at higher
Correct.
DTI rates at 95%. Like
Yes.
so they're going to fill it because it's good business for them, right?
Yeah.
They love a
Very quickly they
95%.
will.
They
Yeah.
love a 95% loan.
Yeah. I would too, but you and I can afford to do that because we've got larger portfolios, right? So someone that's just starting out, let's look at these mechanics. Someone that's just starting out, they've just got their home, they had enough equity to extract, or they had savings to get into a property, and they got 95% LVR. And then the lending climate changes, and APRA comes in and says no more 95 and 95%.
Yeah.
You are well and truly up the creek.
You are. Yeah. You're up the Swanee and all these 95%
Yeah.
first home buyers. I reckon there's quite a few of them in negative.
and how
equity,
quickly can you build up your buffer?
Yeah.
It's just dependent.
really important.
But if you're borrowing at 95%, like unless you're super strategic, like there's a good reason why you're probably borrowing at 95% is because that's all you've got.
That's all you've got.
Yeah.
Yeah.
You know, it's not like being really like some people will be like, yeah, I want to spread it, I want to move it, I want to do this and the other. Like
That's why it's better to get a property with the, you can use your 95, but go in a lower price bracket where you can be a little bit more, manage your risk
It's
a little
more
bit.
forgiving.
Yeah.
forgiving. Forgiving is good, right?
That's
if you do
right.
need to sell, you want to be able to get out and get your dough back.
Yeah. So the key mantra in 2026 is slow down.
Slow
Yeah.
down.
Take time to acquire the asset, because it's if you're going too fast, you could ask the question, who you're competing against.
We had that analogy of the 1,000-meter race. Yes, that's what I was trying to.
Yeah. So what's happening at the moment is they're not recognizing what the race is, right? And they're running a 100-meter dash, whereas the actual race is a 10-kilometer marathon.
Yeah.
Yeah.
And that's
What
what you
happens?
need to
You get
recognize.
burned out, you
Yeah.
gassed, and then you've got to pull out, or you
Or you pull a hammy.
retire hurt.
Yeah.
Yeah.
Yep.
God. Well, there you go. Lots in it. So don't rush into this. Get good advice. Get good counsel. Make smart decisions. Speak to you guys. I would imagine would be your counsel around that. How do you track down the team, Reshmi?
Ooh.
Yeah.
There you go.
My plug.
My plug.
So go onto our website, rightpropertygroup.com.au. There's an inquire or contact me form. If you fill that out, it'll set off a chain of events where we will then talk with you. So it's not like you contact us and tomorrow we'll be talking about a property. There's a lead time. We prepare you for your circumstances and match it to the market. So there's a lot of conversations we have, a lot of finance discussions through the right brokers if you haven't got a broker. And then we get to on the wait list to find the right property for your circumstances. So if you're wanting to buy a property tomorrow, we are not the right fit.
Yeah.
No.
If you're wanting to take a strategic approach to build a portfolio that's going to last you generations, we are the people to talk to.
Okay. Sounds pretty reasonable. It's good. Nice one. Well, thanks for coming in, gang. Good to see you.
Thank you.
Thanks for the coffee.
Yeah. No, you're welcome. It sounds like you guys need a holiday. Go and relax.
I definitely do.
I think
I do. Honestly.
But I think
I'm
I need to
gonna go
come
away.
here more often because I've got to do a budget cut for my coffee. So
You
you're
do.
getting free
Come get
coffees.
free
over here.
coffees, and I've actually asked Victor to go and find me some stuff. So hopefully we can talk about those things.
I'm
at
dragging
point
the
soon.
chains a
I
bit
know,
because
I know.
I'm getting a lot of free coffees out of this.
We had a good look at one.
Yes, we
Yeah,
did.
we did.
We did.
And we said, no, we got scuppered.
Yes.
It's all a
Yeah.
bit dubious.
It
Yeah.
was.
Yeah.
It was.
We'll share that at a point in time. But there's a brief there, so we'll talk about that. But this is the gang over at Right Property Group. Go and check them out, rightpropertygroup.com.au. Thanks for joining us. for Property Investing Insights. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.